All right, welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Ryan Kimmel.
Yo, yo.
It's shortly after 10 a.m. Pacific, December 5th, 2025. Gonna give a shout out. It's a World Cup selection day, so you can watch those festivities. You can look at the new dog mascot for the World Cup that's coming to North America, and hope everybody enjoys that. So with that, we'll kind of jump right into the tail of the ticker tape, and we'll look at the performance during the month of November. I hope everybody had a healthy and happy Thanksgiving holiday. This is our first episode back. November was kind of a mixed bag of a month at a high level. The S&P 500 was up 0.25%, not too great, while the NASDAQ composite was down about 1.5%. Bonds performed all right, with the U.S. aggregate up about 60 basis points, and commodities performed quite well with the BCom up over 3%. Kind of digging into the sectors of the stock market, it was a really a jumbled scenario there where, the technology sector was feeling a little bit of fear, down 2.5%. It was the worst performing sector during the month. That said, you had some pockets of resilience. You can't have the S&P up if everything is down. So you had the best performing sector, healthcare, up over 6%. Energy was another strong performer, up over 5.5%. So kind of a mixed bag there. You had a bit of a rotation away from the high flyers in the AI trade, and you saw that transpire right there. I mean, just digging in to the kind of Russell 1000 value was up over 3%. So it was that rotation out of growth, as the Russell 1000 growth was down about 1.5%. So that was the tail of the ticker tape for the month of November. Kind of looking at the week to date performance, the S&P 500 is up about 40 basis points, and you're seeing the script get flipped, because the technology sector is up about 2.4% on the week, and the healthcare sector is down about 2.6% on the week, we'll call it. So kind of interesting reversal there. The AI animal spirits are out loud and proud again. So, there's definitely been some consolidation this week, but I wouldn't call up 0.4% a banner return on the stock market. When you kind of drill down and look at some of these alternative indices, the S&P 500 equally weighted index, where every stock gets the same weight of capital, is up about 0.5%. So actually outperforming the broad market. And when you look at the Russell 1000 growth, it's up about 40 basis points, and the Russell 1000 value is up about 50 basis points. So pretty interesting performance there. When we go over to fixed income land, what we see is a pretty strong rally at the front of the rate curve, as investors are really locking in anticipation of an interest rate cut at the next Fed meeting Wednesday of next week. But the kind of back end of the curve has kind of sold out currently. And this has been somewhat of a global phenomenon. One interesting fact, to shift gears to the Japanese interest rate markets. If you look at the 10-year JGB, which is a 10-year Japanese government bond, that currently has a yield that is almost a 20-year high. Looking at the chart, we were discussing this on the desk the other day. Right now, the Japanese 10-year government bond yield is 1.94%, and it hasn't been at those levels since 2006. So pretty interesting move there. And you see that in the United States as well, where you saw the back end of the yield curve sell out, the 30-year Treasury out about 13 basis points. So interestingly, you're getting a bit of a steepener too, which we've been talking about for a long time at DoubleLine. The 2's 10-year spread is currently at 57 basis points. So that's kind of a long-winded way of saying, in fixed income, the front of the curve rallied in anticipation of cuts. The back end's kind of sold off and that leaves the U.S. aggregate index down about 0.5% on the week. And naturally the weakest performer is the government sector, down about 60 basis points. The best performer, not surprisingly, in this environment is the bank loan sector, up about 0.25%. And we'll kind of leave it at that. Shifting over to commodity land, it's been a positive week for commodities, up 2%. Energy's been the big driver, up over 6%. Shout out to natural gas. Natural gas is up about 40 cents today in anticipation of colder weather in the Northeast. Um, and so that's a very volatile commodity, but it is driving some return right now. And when we look at precious metals, up about 1% on the week, industrial metals up about 2%. So pretty strong performance in the commodity space. WTI crude's trading about $60 a barrel, and gold is holding in there at $4,215 a troy ounce. Bitcoin has really been volatile over the past few weeks. We were discussing this before the break, and right now it's broken down again below the $90,000 US dollars per Bitcoin, currently trading just south of that. And last but not least, the US dollar kind of dipped a little bit this week, currently trading a 98 handle, high 98 handle, and that kind of wraps up the tail of the ticker tape. A lot going on, but also not a lot going on, not huge moves across the board. What do you say, Mr. Kimmel?
Yeah, I mean, not too much to add, but risk assets led by equities kind of staging a nice recovery after that mid-month volatility back in November. We were highlighting a couple support levels around the moving averages. You had the S&P 500 break through that 50-day moving average and got all the way down and bounced right off the 100-day moving average. And we're kind of just right back up close to near all-time highs. Similar setup on the NASDAQ. It just seems like investors are kind of poising themselves, hoping maybe for that, the seasonally strong period for equities of the Santa Claus rally. Also, you mentioned the Japan government bond yields. Looking at those charts, pretty staggering. And it seems like JGB investors getting a bit concerned about the fiscal dynamics over there, leading to a steeper curve over in Japan, and the BOJ governor basically signaling getting the market prime for a hike at the December BOJ meeting, which would take the policy rates up to 75 basis points, which, believe it or not, would be the highest policy rate since the mid 90s, which is pretty staggering. We're all used to in our careers the deflationary lost several decades in Japan. It seems like definitely markets are signaling a regime shift out of that long-term era. And yeah, Bitcoin, we've been highlighting this as like kind of like a sentiment indicator, and it's kind of broken down and diverged from equities. And it's just kind of interesting, just hovering in this like sub 90 level. I think you really need to see this Bitcoin need to stabilize for maybe risk assets to take that next leg higher.
Yeah, I think you bring up some good points, Mr. Kimmel. Just before we transition to the macro, I think it's important you bring up an interesting concept, the analogies to the 90s period. And, we haven't seen a lot of this action since for decades. One thing that's going to be on the mind of all of the participants in the FOMC next week is this AI investment going to lead to another deflationary cycle, or is it just going to be, not a whole lot there. So that's the huge debate, and naturally, there's the hawks and there's the doves, and they're going to have to be battling it out. So we'll just have to wait and see. But with that, let's transition to the macro for the week.
Yep, it was got some interesting data points, I'd say, during the week. We got ISM PMIs for both manufacturing and services. Manufacturing just continues to remain in these contraction territory, sub 50, and it's been in contraction for the better part of 3 years now. While services remains in expansion, came in a bit stronger than anticipated. Encouragingly, we're seeing a bit of a deceleration in prices paid on the services side, which, was near kind of multi-year highs. So I think that should give some sort of indication, and maybe we're seeing a bit of a deceleration in inflation on the services side. But, concerningly, the employment components for both manufacturing and services remains in contraction territory. And that kind of lines up with some of the other, soft labor market data that we're seeing. We also got the November ADP private payrolls report. This actually showed that, job growth declined by 32,000 for the month of November. And it's been pretty soft for some time now. 3-month moving average is negative 5K. And, 4 months out of the last 6 have shown, job declines. And I think maybe a little bit, more concerning is if you look at they break out small business hiring within the report, which, they categorize small business as firms with less than 50 employees, and that actually showed that, small firms lost 120,000 jobs in November, and actually showing a contraction in firm employment for the year, which, this is important because small firms represent nearly 50% of aggregate employment in the US. So that's definitely something to watch going forward. Also on the labor front, we got initial jobless claims for the week of November 29th. Showed jobless claims collapsed 27,000 to 191K, which is a multi-year low. But I would take this number with a grain of salt because last week, as you know, Thanksgiving holiday period, you tend to get a lot of volatility around holiday weeks and the jobless claims data. So we really need to kind of wait for a few more weeks of claims data to get a better read on joblessness in the US. We also got this morning the delayed very stale data for September for PCE prices and personal income and spending. Won't spend too much time on this because it's just so stale, but I think the most important print was the PC price data, and it was encouraging. You saw a deceleration in the month-over-month prints for core PCE and super core. We saw, core PCE rise 20 basis points month over month, and I actually took the year-over-year number down to 2.8 from 2.9. So I think that should be encouraging for the Fed, even though it's, as of the month of September. Then also, real spending and real disposable income, it's been hanging in there around this 2% growth rates over the last 12 months, which is, not very strong, but it's been pretty stable. So not really seeing any too much of concerning signs there, at least as of September. Then we also this morning got an update on consumer sentiment it was a preliminary reading for December. This comes from the University of Michigan. Showed a slight improvement for the month of December from November, but very dismal levels, hovering around, multi-year all-time lows on the headline number. Sentiment is extremely weak, based on a lot of these survey data points. And I saw an interesting note from I think it was Bianco saying, these survey data is showing very weak relative to some of like the more hard data out there because it's just this average where lower income cohorts are kind of have an equal representation compared to say like aggregate spending data, which is heavily weighted towards the higher income cohorts and can keep that hard data kind of supported relative to this survey data. That was kind of a unique perspective on why we're seeing divergences in the the survey data versus some of the hard data.
I think that's an interesting point. I also read an interesting piece that I shared on the trading desk this week about how AI is starting to disrupt the survey space. So we're just going to have to keep our eye on the survey space as AI technology proliferates because, there's been some researchers that have programmed artificial intelligence bots to be able to fool these surveys into thinking that they're people. And so you got to start to, you know, take those things and make sure that they're really robust if you're going to put much credibility into them.
Totally. And we already like our approach to some of the survey data was already, a cautious, take the data with a grain of salt. So I don't think these notions that you're bringing up are gonna help improve our our how encouraged we are about this sentiment data. I'd also mention too from the sentiment report this morning, we did see a bit of an improvement in inflation expectations, dropped pretty significantly year ahead and a 4.1 long-term, long run inflation expectations declined to 3.2. I don't put too much into these readings, but the charts look less scary than they did a few months ago. And that wraps it up for the economic data releases for the week.
Yeah, that really nails it, and pretty interesting. We're getting this delayed data drop, and it's been encouraging, I guess you could say, but it's pretty in the rear view. We're talking about September now; it's in December, so football season was just starting when this data was being being produced, and now we're just getting the report due to the government shutdown. The week ahead, we got a pretty light week next week, but it's an important week because we have that FOMC meeting Wednesday, December 10th. Naturally, all eyes are going to be on that meeting. When you look at the interest rate market, there's a forecast for a cut, one cut. It's a 95% chance of that. So it's pretty much a lock at this point. And I think everybody's going to be waiting to hear Jay Powell's perspective for any tidbits on forward guidance, though, there's going to be a new Fed chair in 2026. So I think people are going to start to really discount what Mr. Powell has to say at a certain point and look towards the future Fed chairperson for that guidance. Other than that, we have the JOLTS job openings for October and September coming out on December 9th. That's Tuesday. It's going to be, the delayed data that's stale, but we'll definitely be reporting on what happened there. We'll also get the employment cost index data on Wednesday. And naturally, Thursday we'll be getting initial jobless claims and continuing claims. And that's kind of the forecast for next week. Anything I'm missing, Ryan?
No, I think you highlighted it. For FOMC, going to be main center of attention for investors next week. Cut seems 25 basis point cut seems to be priced in for the markets. So it'll be interesting to see like what the guidance is and, what types of dissents we see. And we also get the summary of economic projections. So that'll be interesting to see what type of guidance they're projecting for next year as far as policy decisions go.
Yeah, that's a good point. All the SEP reports are always useful, and market participants look at those with a microscope. So with that, that wraps it up for the week.
Yes, thank you to our listeners out there today on DL Minutes. Hit us up on X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine at our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doublelinecapital. Check out the Odd Lots podcast with Jeffrey Gunlock. That was a pretty good one. And thanks for everyone for tuning in, and I hope everyone has a great weekend.
Take care, everyone. Have a great weekend.